So in today's video, as it says, we're going to be learning how to short, kind of the overview of that, how to short GME specifically, basically it works on any other security, and what actually happened with that whole GME thing that you're seeing in the news. Okay, so there is a more in-depth video on shorting, but here we're going to be mostly focusing on GME and giving a brief overview. Okay, so first of all, we're going to talk about what is shorting. So obviously, if you're coming to this video, you probably know how to long, so how to buy a security. So shorting is the opposite of that. When you're buying a security, what you're trying to do is right there, it says buy low, sell high. So obviously you're buying something at a lower price, hoping or improving price, and then taking your profits when it goes up. Then we're kind of disregarding dividends at this time. So what shorting is you're selling high now and buying later. Okay. So the way that I can kind of explain it to you is think that you are borrowing a textbook from someone. Okay, you go and you go to your friend, in class, and you're borrowing the textbook, or you're borrowing a car, and then you're selling that borrowed car or that borrowed textbook, right? Very risky thing to do. Not something you would do every day, but you would sell what you borrowed. Now the problem is you can't go to that friend of yours and be like, hey, I don't have your textbook anymore, sorry, here's the money, right? They didn't want to sell it in the first place, you just borrowed it from them. So what do you owe them? You don't owe them money. What you owe them is that textbook, or if you don't have that textbook, an exact replica of that textbook. Okay, so shorting is like that. You're going to your bank or your brokerage, okay, and if it's available, you're asking to borrow shares. Okay, now when you're asking to borrow these shares, you're going to immediately sell them. And once you're selling them, you have the money in your account right away. Now here's the problem, you owe them shares, not the money, right? So what do you want to do? You want to give them back your shares, but you want to buy them at a lower price so that you can keep more of the money that you just sold. Okay, so saying all this is a little bit more complicated. I do have a video explaining on this, on my channel, but just kind of an overview here on how it works and how to actually place a short trade. So in the next slide, you'll actually see what a short trade is like. Okay, so everything that I just said, you don't have to memorize, you don't have to go physically ask for these shares, you don't have to physically sell them right away. When you're short selling, it's doing this all for you. So it's just doing one transaction where it's borrowing the shares and selling it for you at a price that you determine. Okay, so here's a screenshot. This is just a random stock. This is Enbridge in the Canadian side. What the biggest thing that you have to know is on WebBroker, you need to open up or any other brokerage, you have to open up a short account. So you need a specialized account, or else you won't have these available. You won't be able to see buy to cover or short sell. Okay, and one thing, I did see a comment in one of my other videos, how do you actually cover your short? So right there, if you guys can see where it says short sell right here in the red, you just switch it over to buy to cover. So this is if you're already in a short position. It'll show as a negative position. You'll see negative 100 shares in this particular case, and then you're buying to cover. So you're buying 100 shares to cover that, so you can zero out. Okay, and then you fill it out as a regular ticket. Your price type. You can set a limit. You can set the market and the expiry date. All right. So you do need a short account. So be careful when you're doing that, because you don't want to buy in a long account. Okay, it's kind of hard to do. To make that mistake, but just be careful. You do need to open up a short account. So if you don't have one, you need to call your brokerage, or if they have an online platform where you can open an account, please do that. Or you need to call your brokerage and you need to open up a short account. Okay, so here you have short sell and buy to cover. So you're gonna fill it out just like anything else. And let's say you're shorting Enbridge, you would short Enbridge. Right here at the price of the time, the bid ask $37.98. So you'll probably be filled somewhere around the $37.98. Let's round. Let's just say you're getting at $38. You're hoping Enbridge is going to go to $34, $35, $36, $30, whatever, and then you're going to be covering that short. Now, you probably will ask, how long can I keep this? Can I hold this to zero? So here's the problem: the bank can call at any time to cover your short, because they, if they need the inventory. If you're shorting something like Enbridge or any other blue chip stock, they'll most likely have the inventory to hold off for a longer time. but generally with the short sell, you need to be prepared for what's called the squeeze. Okay, so now that I've told you that, we can go into what actually happened with GME. So here we see a graph of GameStop. Everyone that is familiar with the kind of gaming world, GameStop is a company that is the business model is completely outdated. It's been by, you know, Origin, Steam, you know, all these other kind of platforms where you can just purchase from the comfort of your own home, and you can get new releases quickly, especially on your computer. You don't have to go in, buy those discs and come back and put it into your game station, you know, Xbox, PlayStation, whatever you have. But what we see here is over the span of some time, it looks like, you know, they were gonna go bankrupt and stuff like that. The price actually shot up there. So before I actually explain what that is, that was called a short squeeze. What that is, firstly, let's explain how the markets work. So the markets are actually a secondary market. So the price of the securities don't actually reflect the financial health of the company. Normally they do, because we are rational people. We are buying stocks of companies that we believe are very strong, will be strong in the future, and current shows sign of growth. Obviously, people did along this line, we obviously did not think so, and we weren't buying. Now, even though this company is doing extremely poorly financially, there was a huge short squeeze here. So what happened? So if a group is dedicated enough to pump a security, so this is why you will normally see this at very, very low valuations. You know, let's say you have a stock that, you know, 5 cents, and people will push it to 50, 60 cents, you know, that would be 10 times, 11 times their money. But here we have something that was pushed from somewhere along the you know, graph of a few dollars to, you know, about 300 or so US dollars. Okay, so basically what had happened is everybody would be shorting the security because they're making money while it's declining. But what is happening is, if people call their brokerage, tell them they don't want their shares to be shorted, borrowed shares to be shorted, and people kind of coordinate this sort of pump, which means they go in and they all purchase at the same time, it'll start to raise the price of a stock. Now, this is also very bad news for people that are shorting it, because they need to come back and buy those shares back, because the brokerage needs shares to sell to the people buying. So this is why it exploded. Not only were people buying, but the people that were shorted needed to cover their positions, which means they needed to go back and buy more shares to give back the positions that they were negative on. Okay, so that's why you see this massive increase right here. Obviously, it then went down because there were things that are set in place, which created an ugly precedence, in my opinion, because it seemed like the hedge funds that were shorting were getting protected, whereas retail investors would not be protected if this happens to them. So, but then it shot back up. So, you know, groups such as Reddit, as you can see, is still, you know, purchasing the security. As you can see through the graph, it shot back up, went back down, very volatile. So this is a very interesting case. This is for, for someone that is very new to investing, this would be a gamble, right? A lot of people gambled on this. You know, it's a prudent advice from anyone that's licensed would tell you, you know, don't do this. You know, this is just something kind of that you would do on your own risk and gamble on, which a lot of people did. But it's very interesting to see two things. One, if you have a dedicated group of people, you can get anything accomplished on, you know, in terms of the market swing. It has nothing to do with a company's performance. You can buy and sell bankrupt companies. This has happened before with another company. I can't really recall the name. If you guys search it on Reddit about, I think 1 or 2 years ago, this has happened before. They were in the States, so that's a chapter 7. In Canada, I think it's a chapter 11, section 11, sorry. When they go in bankrupt, you can pump the stock anytime, anything you like. It's not like the company gets this money, right? Unless they've invested in their own shares. So that's firstly the interesting thing. The second interesting thing is that the response was that I can't remember exactly, but they protected the hedge fund's short position or from not getting squeezed too hard. Okay, so those are the two things kind of that took away. And again, a short squeeze is what happens when a a lot of the short positions are called to be covered, right? So that means a lot of people are now interested in the security and they're buying. So the brokerage needs to go back and sell the shares. They have a debt. You have a debt to them because you borrowed their shares. So you'll need to be called upon to purchase at the next available price. And if you don't do it, they'll do it for you on your own account, either a margin buyout or a short buyout. Okay, so very interesting things. Just to go back one more time, you do need a short account to do this. This is in Canadian. You can also do it on the US side. They have a US short account as well on WebBroker and any other brokerage. Okay, so thanks guys. I hope you enjoyed. I hope you guys took something away. Please feel free to ask any questions. Check out the other videos. They're all about investing and financial literacy. And let me know what else you guys would like to see. Thank you so much and enjoy your day.